Investing can be your fast-track ticket to financial freedom, if you avoid the mistakes that trap so many others. Imagine this. You've put your hard-earned money into what you thought was a sure thing, only to watch it disappear. It's a financial nightmare, right? But it doesn't have to be. The truth is, every successful investor has made mistakes. But the difference between those who succeed and those who struggle is learning how to sidestep the biggest pitfalls. In today's video, we're breaking down the most common investment mistakes, and more importantly, how you can avoid them. Let's start with a classic misstep that affects so many beginners, the mistake of not having a plan. Point 1. Investing without a clear plan. Jumping into the market without a plan is like setting sail without a map. You don't know where you're headed, and that's a recipe for disaster. Before you even think about investing, it's crucial to establish your goals, your time horizon, and your risk tolerance. Without a plan, it's too easy to get swept away by short-term trends or panic at the first sign of a downturn. Imagine the anxiety of constantly reacting to market swings without a clear direction. Would you go on a road trip without knowing where you're headed? So why gamble with your money that way? Once you have a plan, the next key step is knowing the importance of not putting all your eggs in one basket. That brings us to our second big mistake. Point 2. Lack of diversification. Putting all your money into one stock or one asset class can be tempting if it's performing well, but this is one of the riskiest moves you can make. Diversification is about spreading your investments across different assets to reduce risk. It's your insurance against the unexpected. Think of diversification as building multiple income streams within your investments. It gives you a cushion, peace of mind, and a chance to sleep easy, knowing you're not vulnerable to the swings of a single stock or sector. Diversification is like not relying on one friend to remember to bring snacks to a party. It just makes sense. While diversification helps you minimize risk, there's another mistake that can amplify it: getting emotionally attached to your investments. Point 3. Getting emotionally attached to investments. It's easy to get attached to stocks or assets, especially when you've seen them perform well in the past. But emotional attachment can lead you to ignore warning signs and hold on to investments far longer than you should. Imagine the regret of holding on to an investment that's sinking, just because it's hard to let go. Remember, an investment doesn't owe you anything. If it's not serving your financial goals, it's okay to move on. Think of your investments like dating. Don't cling to a bad match just because you have history together. Letting go is key, but there's another mistake that's just as important to avoid: the trap of timing the market. Point 4. Trying to time the market. We've all heard stories of people who struck it big by buying at the bottom or selling at the peak. But the reality? Even professionals struggle to time the market accurately. Trying to guess market highs and lows can cost you more than you gain. Imagine the stress of trying to predict every twist and turn of the market. It's exhausting, and for most people just doesn't pay off. Instead, focus on long-term growth. Remember, time in the market beats timing the market. Here's a question. Do you have a crystal ball? No? Then leave the timing games to fortune tellers and focus on consistency. Consistency matters, but it can be difficult to maintain if you're always glued to the news. Which brings us to the next major pitfall: overreacting to market news. Point 5. Overreacting to market news. Constantly reacting to headlines and breaking news can lead to impulsive decisions that derail your strategy. Markets go up and down, often reacting to short-term events. As a long-term investor, it's essential to tune out the noise and stick to your plan. Picture the calmness of knowing that you're in control, that no matter what headlines appear, you're focused on the bigger picture. Avoid making impulsive moves based on every headline, and instead make adjustments based on solid research and long-term goals. Think of market news like the weather forecast. It changes every day, but that doesn't mean you need to buy a new coat every time. Now, while overreacting is a mistake, there's an equally damaging pitfall on the opposite end: ignoring fees and costs. Point 6. Ignoring fees and costs. Fees might seem small, but over time they can eat away at your returns. Whether it's trading fees, management fees, or hidden expenses, these costs add up, especially over the long haul. Always check the fee structure before committing to an investment. Imagine your returns shrinking, not because of market losses, but simply due to fees. Take control of your investments by choosing low-cost options wherever possible. This simple step can significantly boost your returns over time. Think of fees like those sneaky subscriptions you forget about, except this one could cost you thousands over time. Finally, once you've learned to manage costs, there's a last critical mindset to avoid: focusing only on short-term gains. Point 7. Focusing only on short-term gains. Chasing short-term returns often leads to risky bets and frequent trading, which can do more harm than good. Wealth building is a long game, By focusing on steady, consistent growth over the years, you allow compounding to work its magic. Imagine the security of knowing you're building a financial future that will last. Short-term wins might feel good in the moment, but it's the long-term strategy that brings real freedom and lasting wealth. Ask yourself, would you rather have a quick win or a lifetime of financial security? If you're serious about achieving that long-term wealth, there's more to learn, and your next step could be the most important of all. Avoiding these common investment mistakes can be the difference between building lasting wealth and facing constant setbacks. By having a plan, diversifying, keeping emotions in check, avoiding market timing, filtering out news noise, watching fees, and focusing on long-term gains, you'll set yourself up for success. Ready to take the next step? Click over to my video on how to build wealth in your 20s to dive deeper into proven strategies that set you up for a prosperous financial future.